Okay, it's part 2 of trading options, and it's not as hard as we think. In part 1, we talked about when you buy a stock and you want it to go up, you buy the stock. But when you buy the contract for leverage to make it go up, well, you buy calls. And if you want a stock to go down, you could short it. But if you want leverage and you want to make a lot of money much more quickly, then you buy a put if you want a stock to go down. So we already know that we buy calls for stocks to go up, puts for stocks to go down. 2 more important pieces of information that you need to know. We know to buy a call when we want the stock to go up, but you need to figure out what price you're calling that stock to go to. And the next piece of information you'll have to decide is the expiration date of your contract. So we'll talk about the expiration dates in part 3. For now, let's talk about a stock that's $100. And suppose it goes up to $102 when you buy the stock, just the shares. You went from $100 to $102. And, well, my editor will show you made 2%, right? From 100 to 102. You made 2%, and maybe you made that pretty quickly. Maybe you made that 2% in just one day, which is amazing. You can change your life if you do that consistently. But did you know that with that same $2 move, you can make 20%, 40%, 200%, depending on the calls, the options that you bought? So here's what we need to do. When we think a stock's going up, we need to decide how high it's going to go, because we have to pick that strike price. If the stock's that $100 and we know it'll go to 102 quickly, and that's it, we're not sure if it'll go further, then $102 is probably the best strike price. Meaning, we're going to buy that contract betting that the price of that $100 stock can get to $102. That's the strike price, simply the price you think it'll go to. Well, Rick, I looked back on my charts, and the last time that stock pumped, it went to $105. Great. Maybe you should buy a call for that $100 stock with a strike price of $105, because if it goes all the way up to $105, won't you make more money? Sure. You buy stock and it goes up to $105, you made 5% instead of just 2%. So if you buy a $105 call versus a $102 call, yes, you'll make a lot more money. Now here's the catch. Remember, everything we do with options is leverage. So if you buy that $102 call, it only has to get to $102 to start making you a lot of money. In fact, it only has to get part way to $102 for that leverage to kick in. But if you buy a $105 call and it has trouble getting to $105 in that same period of time, well, you won't make nearly as much money as you would if you bought the 102 call and it approached 102 quicker. Now, if it gets to 105, sure, you'll make a lot more money, but that leverage comes at a price. You have to get close to that strike to start really making big returns. So for me, because I like to win more than lose, I'll always buy a strike price that I know is easy to hit, is close, and when I look back at my charts, it got there before. If that makes sense, then you're on the right track and you're ready to start winning with options. We're going to have to talk expiration date next, but remember, we buy a call reasonable with a strike price of a price that we believe that stock will get to. How soon will it get there? Well, that's the key. How fast it'll get there is the next video when we talk about expiration dates, because that's just as important. So, buy a call, pick a price. You don't have to be perfect, but pick a price that you can get there and you can make lots of money. What about puts, Rick? Well, remember, if you're betting the stock will go down, you just buy the puts. Same principles apply. If you think the stock will go down from 100 to 98, you would buy a $98 put. Remember, you always buy the puts, you never sell them, even though you're betting that the stock will go down. See you on part 3. Love you.